Hi, Steve.
Hello.
Thank you very much for taking the time to meet with me in your offices in New York today. It's an honor to have the opportunity to interview one of the pioneers of our private equity industry in North America. Could you please first introduce yourself and share with us the key milestones of your successful professional career?
Yeah, well, thank you, and thanks for having me with your group. I'm Steve Klinsky. I'm the founder and the CEO of New Mountain Capital. I'm one of the longest-standing private equity people you're likely to meet in the United States. I came to New York in 1981 as buyouts were just beginning. I was co-founder of Goldman Sachs' original private equity group, did their first ever principal investment, did about $3 billion of transactions there. Then from 84 to 99, I was with the second biggest firm in the world of those days as the senior person outside the family in their glory years. And then I started New Mountain in the year 2000.
And what is your role today at New Mountain?
My role today is I'm the founder and the CEO, and when people say, well, what does that mean? I say, I drink coffee, because we have a team of 260 people, and everything is being handled by specific people, and I try to make sure the firm is going right. I'm the senior portfolio manager, and I'm here every day trying to build the culture right, trying to make sure we're making the right decisions, have the right people in the right places.
And could you please introduce your firm, New Mountain Capital, and its history to us?
Yeah, New Mountain Capital has, I think, been one of the major successes of the last 25 years. We officially started January 2000. We've gone from no capital to $55 billion. We've created about $87 billion of enterprise values, have never had a bankruptcy, never missed an interest payment in the history of our firm. And what we try to do is we think of ourselves as a business that builds businesses. We pick non-cyclical growth sectors that we call defensive growth sectors, usually by a mid-market company, and build it. And it's all about, protect the downside and build the business for the upside.
That was my next question, and that at the heart of your investment strategy is the concept of defensive growth. So you started to talk about it, but could you please explain what it is exactly?
Yeah, well, one of the things I should add about my background is I come from a small family business. Many people here come from family businesses. We say we have family business theory, not portfolio theory. We don't think one company does well and two others go bankrupt and we came out ahead. We want everything to be safe, sound, protected. And so we always think about protecting the downside first. Part of that is being in non-cyclical sectors that can grow, but we can always be in the right space for the years ahead. We keep the capital use of debt controlled, and we really add value to the business.
And that's how you explain that you've never missed an interest payment in the whole history of the firm, basically.
Well, knock wood, we're going to try to keep it going as long as we can. But if you're in, some of the greatest mistakes in private equity are when the whole industry melts underneath you. If you're a toy store in the mall and you're fighting Amazon, you're just in a very bad space. So we're in things like life science supplies, healthcare technology, infrastructure services, must-have big data. And we keep evolving our list so we can always be in the right place for the years ahead, which is one of the key advantages of private equity. You don't have to inherit your grandfather's iron foundry and do well in iron foundry. You can always pick the best sectors for the years ahead. So in those sectors, we don't use as much debt as we could get. We usually use about 4 times debt to EBITDA. So if there is a problem, we have time to go in and fix the company. And we have over 100 operators associated with the company, plus our own deal people are very operational, so we can go in and fix the business.
And could you explain how your thematic deep dive sourcing approach work?
Yeah, so we want to be in the areas that if we're going to hold a business for 5 years and someone's going to think about the next 5 years as they buy it, what sectors of the economy can be good for the next 10 years, even if oil prices go up or down or housing starts go up or down? We call those defensive growth sectors. And we have a whole formal top-down process to choose and evolve those sectors, which we've had for close to 24 years now. We have 12 sectors fully staffed up with 25 subsectors with multiple team leaders, operating partners, every industry expert we can find. And that is what drives the companies we're looking for. We look at hundreds of companies in each of those space, trying to buy maybe one a year, and that's how we get stronger and stronger in specific areas, and I'd be happy to give you examples, but that's the way we do it.
And why do you prefer your senior investment professionals to focus on 2 to 3 subsectors as opposed to be specialized in a single sector?
Yeah, in any sector, I believe there is no one better in those sectors than the team collectively. We don't want a person to say, I'm the telecom guy, and if I can't get a telecom deal in this fund, then I have no role, because then they try too hard to force whatever sector they're in into the portfolio. They don't have the breadth of vision to see outside of their own narrow space. Whatever area we're in, it goes back to, is it defensive? Can we grow it? Are there barriers to entry? Can we make, we're looking for 30% returns or better on each investment. Can we do that? And it's not a question, well, my sector trades at this price today. So we want people to be able to think logically across all sectors, work with each other on different sectors. It builds a much stronger culture. Everyone in the firm gets carry on every deal from the receptionist on up. So you have a more intellectually honest culture when people are not just obsessed with getting their own deal in the portfolio.
And it's also how in 2021, I think you avoided some of the hot sectors, right?
Yeah.
Because of valuations.
Well, for example, we've done incredibly well in healthcare IT. We've had companies like Equian that went from $400 million to $3.2 billion, and Signify went from $500 million to $8 billion. And we may be the best in healthcare IT. In 2021, when other firms were paying huge prices for healthcare IT companies, I don't think we bought any, because we knew the price in that space was too high, and people in that sector could also be calmly working. I think we were buying up a lot of infrastructure services that year. So the great thing is we can be the best in spaces, but not feel irrationally compelled to get something done.
What return do you typically underwrite for your buyout fund?
So we've always had the same investment criteria since the firm began. I don't think I'm allowed to give you the returns because of compliance, but our returns have been going up fund after fund. We've been top quartile again and again and again. We have the same questions at investment committee. Question 1, is it safe? Can the team convince everyone in the firm that even if the world goes bad, we should make roughly a double? And question 2, though, is do we really think there's a chance for a 30% gross return on that investment or better? And frankly, we've been exceeding those targets on our many recent exits. And so that's what we're always looking for. If anything, our investment criteria is getting higher and higher as time goes on, or the committee is getting stricter and stricter because we've had good success. And we look at maybe 1,000 companies a year to buy 8 or 10 now. So it's pretty hard to get through investment committee these days.
Who are the typical investors of your funds, and what would be approximately their average commitment?
Yeah, I think we have 350 investors in our latest private equity fund. It's a whole range. So, 25 years ago, a lot of our major investors were the big state pension funds in America, like the California State Pension Fund or the Pennsylvania State Pension Fund. People like California are still with us today, but we've broadened out as fund after fund. We're very strong with European institutions, very strong in Japan, very strong in other parts of Asia and the Mideast. Increasingly, we really started with major institutions and sovereign funds like the Canadian funds. More and more family offices are becoming like institutions and are coming in with us as well.
And maybe could you please elaborate on 2 of your buyout transactions? Maybe explain how New Mountain sourced them and how you have created or are creating value with them.
Okay, I'll give you 2 that were recent exits. And one, I wrote an article for the Harvard Business Review, which any of your people can just go online and get. So we use it as a case study. It's a company called Blue Yonder. It started as a little software company called Red Prairie for about $500 million that was a supply chain software company. We built it into the world's leading supply chain software company. We added AI to it years before people were talking about AI. That's where the Blue Yonder name came from. Took it globally, put in whole new management, changed the product line, and ended up selling it to Panasonic of Japan for over $8 billion. But that, again, it was a safe, maybe boring base. And then what the article goes through is the 9 years of business building we did to get it that size. Another example, a company we sold last year is called Signify. we pick the thesis that we think will be important to companies in America or just important to the world. One of the things in the United States is our healthcare system is very expensive, very inefficient. If you could get into people's homes to help them stay healthy at home, you could prevent a lot of costs and a lot of suffering. There was no company doing that. We found two little businesses owned by different buyers that we put together, renamed them Signify, put in whole new management, whole new strategy, changed all of their back-end technology so that a doctor who used to get to 9 homes in a day could now get to 10 homes in a day. That made them the most cost-efficient, highest productivity company in the space. They went from about 250,000 home visits to about 4 million home visits. And then last year, when the stock market was very weak, we were still able to sell it to CVS, the giant pharmacy chain that owns Aetna Healthcare. And we had bought it for around $600 and we sold it for around $8 billion. So those would be two examples. And but the basic story, whatever it is safe base, good industry, keep it safe, but find ways to take it, to build it into a new mountain in the industries that we invest. That's where the name comes from. We are not mountain climbers. We're not hanging on cliffs. It's the idea of building organizations, including our own firm, with permanence and quality, and that's the idea of New Mountain.
Turning to the market, what's your perspective on the current market environment? Do you think it's a good time to invest?
So we've had really strong success year after year despite market conditions, which is why we just finished raising Fund 7, had a good fundraise and all that. We've sent $19.5 billion of cash back just since January 21. So we continue to get good exits like a Signify that I talked about, because if something's high enough quality, you can still sell it even in this market. Where we've had even better luck lately, I think, is, in the last year and a half, some other firms had overspent in 21, like you were referring to, had kind of spent too much when prices were high, and then were staying out of the market when prices were low, and we've been very steady through it all. So we made some great acquisitions in the last year and a half when I think other firms were kind of licking their wounds, and I think got some exceptionally good buys. I mean, I think we're getting back to more normalized market conditions now. The credit markets are open to lend. Interest rates, if anything, appear to be drifting down a bit. Inflation is fairly normal. So it will be, I think, just kind of normal market conditions or close to them at the moment.
And how do you see the private equity industry evolve over the medium to long term?
Yeah, and I've also been chair of what's called the American Investment Council, which represents all 5,000 firms in the private equity field. What I say, and I give speeches about this sometimes, is over the last 43 or 44 years that I've been in the space, I think private equity's evolved from a form of finance into a form of business. It's no longer, and I can talk about the market conditions in 1981. Interest rates were 15.8% in the 10-year Treasury. Inflation was high. What's happened, though, is over the years, a firm like ours is not dependent on interest rates one way or the other. You become a business that can add value to businesses and become more and more operational and more value added. And it's really a form of governance. Unlike a public company that has to worry about every 90-day reporting, we can be totally rational, own businesses for years, recruit the best managers, incent them well, and just build businesses privately for 5-year periods or longer. And that's just a great governance structure. So we're not the only good private equity firm, but I'm sure you've picked other good firms, but good private equity firms should really be super business builders in today's world.
Fantastic. Thank you very much, Steve, for taking the time to speak with me about New Mountain, and sharing your insight on the private equity market.
Well, thanks so much, and thanks for being our partner.